So we have to look under US GAAP how to give the treatment for finance lease and operating lease. So under US GAAP, other than these differences, what we have covered in the previous topic, so that we have discussed under US GAAP, like how they give the treatment under IFRS. Now under US GAAP, we are saying, okay. So differences in the cash flow classification. We have seen how the cash flows are treated differently in US GAAP and IFRS. A finance lease that is not short term is reported just as we have described for leases under IFRS. That means for finance lease, every treatment what we have given in case of IFRS, the same is applicable for US GAAP. But if a lease is for a short term under finance lease, okay, then what we have to do, we will see. For so here the point is very clear under US GAAP. If there is a lease agreement which is for long period of time, not for short period of time, okay, and the agreement has the the agreement is a agreement, you have seen the conditions, right? So any of the conditions satisfied, 5 conditions, we can say it's a finance lease. And if the finance lease is for long term, then you would give the treatment similarly as you have given for given under IFRS, okay. But if at all there is an operating lease and that is also not for short term, for long term, under US GAAP, a lease liability is also recorded and amortized as under IFRS. So for any kind of operating lease which is for long term, we show lease liability and we show the leased asset, and then we amortize this leased asset, okay. However, the right of use asset is not amortized straight line. So there is a different effective interest rate maybe is what we will check out, but it is not amortized. The right of use asset is not amortized on straight line basis under operating lease for long term. Instead, it is amortized by the same amount each period as a decrease in lease liability. So that is the point. So the amortization in case of operating lease for long term is not straight line, but it is the same amount, okay, like which would be decreasing the liability, the lease payments, right? The same amount would be taken to amortize the leased asset. Okay, so instead it is amortized by the same amount each period as decrease in the lease liability. So that we will be seeing with the help of a practical question. So that the asset and liability are equal in each period of the lease, and on the income statement, interest expense and amortization of right of use asset are not reported separately. They as you know that we write them separately in case of finance lease, but they are combined and they are shown as lease expense. So I will write the summary here: operating lease for long term, lease asset and lease liability amortized by the same amount. So there are slight differences. Leasing, it is not very tough concept to study or learn, but the thing is the slight differences are ones which are very crucial to be understood. Okay, but what happens in income statement? Lease expense is nothing but whereby in finance lease we used to show the interest and the amortization of the lease assets separately, okay, but here we are going to combine them and we are going to show them as lease expenses. So lease expenses is a combination of interest expense plus amortization, okay, of leased asset. So let's go ahead and see a question here and try to compare. So let's see accounting for an operating lease under US GAAP. Using the same data from the previous example, calculate the impact of lease on Affordables financial statements if affordable reports US GAAP and the lease is classified as a operating lease. So we will discuss. So here we have the liability at the beginning and the lease payments are 10,000. Okay. You see at the end what is happening. Your lease liability and your right of use asset are same amounts and they become zero also at the end. So this is the beginning liability. This is the interest expense. On this we calculate, and this is the lease payment. We deduct this from this and we get the this is the principal element in that. Okay. So now what will happen is the principal repayment, what has been done, the same amount will be deducted from this and this. Unlike in case of the IFRS, whereby we were dealing with the finance lease, we took the right of use asset and we did a straight line amortization. Here it's not like that. The same amount is removed. So this amount is removed from this and this, and you see the same amounts here. And on this again the interest is calculated and again deducted from the lease payment, and you have the principal repayment thing here. The same is deducted from this and this. You can do the calculation simultaneously. I'll give you some time. Okay. Yeah, please do the calculation. I'm just giving time. So you can take the calculator and do the calculation, and I'm giving some time for that purpose. So you'll find that every time this is deducted from both the figures. Okay. And then on the balance sheet, the book value of the right of use asset is amortized by the same amount each period, and the lease liability is equal to the principal and same each period as the lease liability. That is, the amortization of asset is equal to the principal repayment. So amortization of asset is equal to principal repayment. And what happens in the income statement? The lease expense, as I said, is the combination of what? The interest here plus amortization of right of use asset, which is this. So which will equal the lease payment. So amortization is equal to principal repayment each period, and the principal repayment equals the lease payment minus interest. So lease payment is this minus interest will give you amortization of the asset, okay, which is equal to principal repayment of the principal element. As a result, amortization plus interest each period is equal to the lease payment of 10,000. And in the cash flow statement, what happens? The entire 10,000 cash outflow is classified as cash from operations. Okay. That means we take this 10,000 lease expense in cash flow from operating activities. Now, let us do a comparison of finance and operating leases under US GAAP. What is happening? Let's see. This case was this was the case of operating lease for long term. So in the balance sheet, as we have already discussed, under finance lease, US GAAP and IFRS treatment is same. Okay. Under operating lease for long period, US GAAP has a different treatment we have discussed. So balance sheet, right of use asset. Okay. Here it was straight line amortization. You can check that 35,460 divided by 4, 8865. 35,460 minus 8865, 26,595 minus 8865, 17,730 minus 8865. So here it was straight line amortization. In case of operating lease, it is not like that. The principal repayment, principal element in the lease payment was the one which was deducted every time from the leased from the right of use asset. Okay, you know the figures, right? The figures are here. This were deducted every point of time. Under lease liability, the principal elements are removed, and here also the same thing. Okay, both are having the same treatments. Only the treatments were differing in the case of right of use asset. Here straight line, here principal payments. Income statement, interest and amortization both are different. And those total and become this. But in case of operating lease, the principal element plus interest is equal to lease payments, and you see the same figure every year in this case. Okay, so these two are separately shown and total this, but we have to show separately. So please go through this question once, Tarun, and I will be going ahead. Okay, please have a look through this fast, giving you some 2 minutes of time. Just a second. Okay. Note the following when comparing finance lease accounting and operating lease accounting. The lease liability is same each year under both the methods. Yes, see, we can see that the lease liability is same under both the methods, whether we take operating lease or we take finance lease. The right of use asset is not the same except at the initiation of the lease and at the end of the lease. The right of use asset is not same, but during the initiation of the lease, you see them equal, and also at the end of the lease term, you see them equal. Operating leases report higher right of use assets. That is like when you see the comparison, you can just do the comparison here, not a big deal. You can see that the right of use asset is that here it is having a higher value every point of time. Right of use asset matches the lease liability in each year for the operating lease. The right of use asset only matches the lease liability at the start and end of the year, end of the lease life for finance lease. Yes, let us check it. In the case of liability, every time it is equal. But about the where we go there. In case of the right of use asset, we have seen, right? Right of use asset only matches the lease liability at the start and end of the lease life. So we will match the right of use asset. During the starting, the right of use asset are same with the liability, and at the end also it is same with the liability. Finance lease methodology reports both interest and amortization expenses in the income statement. Yes, separately, and here they don't split and they club it and show. In earlier years of the lease's life, income statement expense is greater in total for the finance lease. We can check it here. Here you see every time it is greater and it is decreasing. Here it is fixed. Because what is happening here, the interest element is going on decreasing and the principal element is going on increasing. That's the reason why this will decrease. So all comparisons done, and impact on financial statements. See, balance sheet, assets, right of use asset, finance lease, IFRS and US GAAP, same treatment. What is happening? Balance sheet assets here, we will compare. Here it is lower, here it is higher. Analysts have to check this. That is now compared. Balance sheet liabilities same, both the cases compared. Income statement, earnings earlier years are lower and here it is higher. We can check. Income statement earnings early years, finance lease lower. Earnings is actually from the perspective of lesser. Just a second. But here we are speaking about expenses. We have to go to lesser's account. But we have done the lesser's account. Okay. Okay, I can understand why it is so. See, here the expense is more. So income will be less. Here the expense is less. So income will be more. So here the expense is more in the initial years. So the incomes or earnings will be less in the initial years. But as the time passes by, the earnings will, increase and the expenses will decrease. Vice versa will happen, and here it will be similar. So income statement earnings, early years lower because the expenses are high in the early years, and here higher because expenses are lower when compared to finance lease. Income statement earnings later years, as the expenses are decreasing, the incomes will become or earnings will become higher. Here it will be lower because compared to this will be having more expense. So earnings will be low because 10,000 is fixed here. It will go somewhere around 9,000 change. Earnings before interest and tax, like before deducting the interest element, we will check, see what happens. We are not taking this, so this will be a smaller figure when compared to this. It will be higher in case of finance lease because they're not clubbing it. Higher, lower. Interest expense in this higher, in this lower. Operating cash flows higher, lower. It depends upon the figures. See, if the see what happens, that will go into under this. It will go where cash flow from operations. See, we will see the differences. Repayment of principal will be classified as cash outflow from financing. Under IFRS, the interest portion of each payment may be classified as either operating or finance. You can show anything. US GAAP operating only. So operating cash flows you show, it's your wish. If you don't want to show, you don't show in operations. This will be higher. If you show here, it will be lower. Okay. And financing cash flows, if you show, this will be lower, this will be higher because you don't show them in the financing cash flows. Now let's understand this one and go into the lessors accounting for short term less than 12 months or low value leases under IFRS. And for short term leases under US GAAP, no lease asset or liability is reported on the balance sheet. Each period lease payment is reported as rental expense on the income statement, spread straight line over the life of the lease. That means every year fixed expense. So here we have operating lease, finance lease, both treated as finance leases for accounting under IFRS in the books of lessee. So if at all I'm speaking about operating lease or finance lease, you know what is finance lease? 5 conditions. No, not satisfied any of the conditions, operating lease. Both treated as finance leases for accounting under IFRS. But short term or less than 5,000 expensed straight line. Okay, because short term lease you will be going for fixed expenses every year. You will show them as a rental expense. Okay. US GAAP expense straight line less than 5,000. They have given the figure also. Operating lease, finance lease, different methodology. Yes, we have seen operating lease and finance lease. Finance lease same like IFRS. Operating lease for longer time. We have seen how to treat, and expensed short term is always expense straight line. Now let's go ahead into the lessors accounting. See, under both IFRS and US GAAP, there are two lease classifications for lessors: finance leases and operating leases, just as for lessees. So whatever treatment you gave for lessee, reverse treatment have to be given for lessor, because payment for lessee is earnings for lessor. Liability for lessee is asset for lessor. Payables for them, receivables for them. So at the initiation of a finance lease, the lessor removes the leased asset from its balance sheet and adds a lease receivable asset. So you will be now having like small element of doubt, like whether the lessor will be showing the asset in the balance sheet or not. Yes, the lessor owns the asset. So the lessor hasn't transferred the ownership rights to lessee. We have already discussed about that. Lessee only has a right of use asset, but the accounting treatment should be very precise. The asset which the lessor is leasing to lessee, the lessor will be showing that now or will be replacing that leased asset with lease receivable asset. That's what. So leased asset after agreement will be replaced with lease receivable asset in circle equal to the value of the expected lease payments. Okay, expected lease payments, like liability, you had the liability whereby principal element was there, interest element was there, principal you were removing, and then the lessee was having the outstanding liability of lease, that is the receivable for lesser. If this value is different from the assets book value, lesser will recognize a profit or loss. So any difference in the book value and the market and the value what he's getting, he will show profit or loss. We'll see the accounting. Over the term of lease, the lessor will use the effective interest method. Yes, this also I will be explaining you. And amortize the lease receivable and will report the interest portion of lease payments as income. So what is the lessor going to do? He is going to use the effective interest method. Okay, to amortize lease receivable, because lease receivable is also going to decrease every year, right, as the payments will be done by the lessee, and the lease payments done by the lessee to the lessor, the interest portion is so we'll report the interest portion of lease payments as income. So interest is income for lessor, will be shown in statement of profit or loss or income statement. Just a second. So, so interest income is included in the lessor's revenue for the period. See, interest is an income for them, right? If the firm is a manufacturer or dealer of leased assets, so there are many aircraft manufacturers who manufacture aircraft and they lease to the airline companies. So this interest income becomes their revenue. Okay, if at all they are manufacturers or dealer. On the cash flow statement, entire cash inflow is classified as cash from operations. If manufacturing or dealing in leased equipment is the main business operation of the firm, the sales proceeds will be in the revenue line and the carrying value of the asset will be a cost of sale. Yes, because they are manufacturing the goods, right? For them, the aircraft manufacturing or whatever they manufacture, it is a goods for them. So what they will be showing, they will be kind of, this asset will be given to the lessee and they will be showing the sales proceeds as revenue, and whatever the cost they have incurred to make that asset, they'll be showing under cost of sale. In other words, the treatment is like selling inventory, the same thing. Both IFRS and US GAAP refer to this treatment as sale type lease. Please try to understand. Okay. So next topic. If the lessor is a financing company, that means they are providing the asset to you. rather than manufacturer of the leased equipment, or a gain or loss is not recognized at initiation. Instead, gain or loss is deferred and is recognized over of the lease as interest income. That means they are a finance company. They are doing the finance for you. They are kind of buying the asset and giving to you, not like they are manufacturing and giving to you. Okay, so that point of time it becomes inventory, but here they are buying for you and giving to you. Okay, on a lease basis. So they will be earning interest, of course, and in the gain or loss. So what happens if the lessor is a financing company rather than a manufacturer of the leased equipment? A gain or loss is not recognized at initiation, of course, as we saw that they are showing revenue and cost of sales and they are making some gain. Instead, the gain or loss is deferred because they will be earning the income in the future, like as interest income, and it is recognized over the life of the lease as interest income for a gain or expense for a loss. IFRS and US GAAP refer to these type of leases as direct financing leases. Okay, so please have a look through all these points. We'll go for a question. Okay, just give a reading to this question, Tarun. We will solve this. So lesser accounting for a finance lease. Okay, so not everything is tested in your syllabus. We are dealing with finance and operating leases. Okay, sale type lease and all those lease they have not given in the syllabus. They are just mentioned some kind of basic regarding that. So no need to worry about all these things. We Our prime focus is on the operating and the finance lease. So the expensive company is a lesser to affordable company. So affordable company was a leasing company, was the lessee. We have already seen about affordable company, and now we are learning that expensive is a lesser to affordable from our lessee accounting example. Expensive it is a manufacturer of equipment being leased. So they manufacture it same. Okay, and let us see now what kind of treatment has to be given if they are manufacturers. From the previous lessee examples, the lease had annual payments of 10,000 over a 4-year period. At the end of the lease, which is also the end of the machine's useful life, affordable will return the machine to the lessor. So here there is a the machine by affordable will be returned to expensive. The interest rate implicit in the lease is 5%. Expensive believes the asset will be having a residual or scrap value of 2,000 at the end of the lease period. Carrying value of the asset recorded as inventory in the lessor's balance sheet is 30,000. Okay, this is the total question. So why the asset is recorded as inventory? Because this is manufactured by the expensive company or lesser. Okay. Now what we will do first, calculate the impact of lease on expenses financial statement for each of the 4 years if the lease is treated as finance lease. So, you know, so calculate the impact of lease on expenses financial statement for each of the 4 years if the lease is treated as finance lease. So now you have understood in case of finance lease, we have to find out the present value of lease payments. Why we need to do this? To find out the right of use asset and also the lease liability, because we are treating it as a finance lease. So present value of lease payments was this 35,460. Already we have done the calculation. And now in this, the lessor is also going to sell the asset for 2,000 in the market. Okay, at the end of the lease period, or the expensive lessor believes that he'll get 2,000 of scrap. So present value of that also we will do, because present value of all future cash flows is what we are going to take. 1645. Okay. So cost of sales is what actually? Cost of sales is equal to assets carrying value less the present value of the scrap. Okay, this is the cost of sales. Why? See, very simply they have given, they are recording the carrying value of the asset is recorded as inventory of 30,000 in the balance sheet. Okay, so this is the value they are going to record the asset at. Okay, but this one they are going to get some part of the asset as on today. If they sell, they're going to get this much. Okay, so if I remove this, I get the cost of sales. Fine. Now I will compare the cost of sales with the present value of lease payments. This is my revenue, this is my cost. So my gain or loss is 7,105. Okay, that we have already discussed here. We have discussed what? If the lessee, if the lessor is a manufacturer. So we have seen here, if where is that? Yeah. If manufacturing or dealing in leased equipment is the main business operation of the firm, the sales proceeds will be in the revenue line and the carrying value of the asset will be the cost of sales. So carrying value of the asset is inventory, right? Here, inventory in the sense the asset is treated as inventory and that is shown in the balance sheet at its carrying value or book value. So sale proceeds is present value of future lease payments. Okay, that is the sales revenue as on today, and cost of sales is cost of sales, which has to be subtracted from sales, is nothing but the carrying value of asset. Okay, so we have seen here, this is the revenue, this is the carrying value. So this is what we are going to get. But today if we sell some portion of it, we are going to sell at 1645. We remove it, we get this much net. And this is the gross profit. Okay. Now balance sheet, lease receivable asset and interest income. You know that they are going to remove the asset and show it as lease receivable asset. This is the net investment in the lease, and this is the scrap also they are going to get. This is the total value as on today. This is the lease receivable asset. This they are going to expect in the future that this is the receivable for them. Okay, with from the perspective of this particular asset what we discussed. Now let us go ahead. The net investment in the lease is equal to the asset's fair value or market value. This is because the interest rate implicit in the lease is the IRR that makes the present value of lease payment received and the residual value equal the asset's fair value. Okay, so you need to understand that net investment is the what we have calculated is nothing but the assets market value, because the interest rate implicit in the lease is IRR. IRR means what? Present value of future cash inflows. See the discount factor at which your like NPV is 0 is IRR. So what they are saying, present value of cash inflow should be equal to present value of cash outflows or investment what you have done. So if these two are equal, these two can only be equal at the discount factor, which is IRR. That's what they are saying. So the rate implicit, interest rate implicit, which is 5%, I think in this, in the lease is the IRR. Okay, that makes the present value of lease payments, PV of lease payments received, equal to the residual value, PV of the lease payments received and residual value plus residual value or scrap value equal to assets fair value. So these two are equal at 5%, which is the interest rate implicit. Okay, then this is acting like IRR. See, at this rate of 5%, which is your expectation to receive. Okay, if you calculate the present value, that is equal to today's market value, which is equal to present value of lease payments and the residual value as on today. That's what. See, your estimation is based upon your expectation, what you should be getting, what you want. So you want 5% rate implicit in the lease. So today's fair value, whatever you are looking forward based upon your estimations, is nothing but equal to the present value of lease payment and the scrap value for the future lease payments and the future scrap value as on today. Present value of the future lease payments and the present value of the future scrap value as on today. This has been discounted at 5%. Okay, so today if see whatever the returns you're expecting is 5% for the future, I removed all of them. So today I got the present value that should be equal to the fair market value as on today. Finished. So present value of those future payments today what we have is nothing but the value at which if we sell is the value we will be getting from the market also, because every person who wants to buy the asset will be doing the same calculation and calculating the market value in that way. It's very simple. Let's say I'm expecting 110 rupees after 2 years at the rate of 5% returns. Let's say for example, today it is 100 rupees and that is the market value as on today for this 110 in the future. So 110 of future after 2 years is present of today. Present of today is equal to the market value as of today. So now do this calculation and wind up this one. Beginning lease receivable asset, net investment in the lease. We did the calculation. Interest income they are receiving 1855, which is 5% of this. Do the calculation please. So that is their receivable, right? So on receivable they are going to charge interest. 1855, and this is the lease payment they are receiving. So this subtracted from this will give this. This will be again subtracted from this. That is the amortization of the lease receivable asset. On this again 5%. Okay, effective interest. So you will be removing, you will be just multiplying and finding this rate. You got this much is gone, this much is to be received from the lessee as principal repayment. Fine. And again this will be removed from this, and this is the resultant figure, and again this you are supposed to receive. Again 5% interest you'll be receiving. They are giving this much is still to be received, and this is the balance after this subtracted from this, and this goes on. At the end you will be only expecting the scrap. At the end of lease period, the lease receivable asset is equal to the expected residual value of the asset that I have discussed right now. If the lessor disposes of the asset for any amount that differs from scrap value, a further, see, if at all this is what you have expected, you are selling it for 2500, you are getting a gain of 500. Selling at 1600, you're getting a loss of 400. So that also you have to account. Okay. So we will, stop here. Tomorrow we will go ahead with lesser accounting for an operating lease. I will wind up the lease topic tomorrow. We'll go for deferred compensation, defined benefit plans. I think the next class can be the end of this chapter. Okay, because only theory topic is there, no practicals. Okay, Tarun. Thank you.
Okay, sir. Bye, sir.
Thank you. Bye bye. Bye.